Hello, and thank you for tuning in to today's video. I'm Gayatri from Index One, and I'm joined by Chris McKeffy and Craig Camille from BX. Welcome to Portfolio Strategies Outlook, which is a quarterly content series designed to keep you informed on market trends and evolving investment strategies. Be sure to subscribe to our email notifications so you don't miss the next video. In this session, we'll recap recent market developments, analyze strategies that have been performing well and those that haven't, and explore emerging investment approaches. We'll also highlight new strategies to be calculated by Index One and onboarded on BX. With that, Craig, over to you.
Thank you, G. Yeah, and just one quick comment on Index One and BX. So if you go to indexone.io, everything we're talking about today is located on there. There's currently about 140 indexes. What makes this platform very unique is the vast majority of those strategies are active. There are some that are passive, but what our firms specialize in is locating index managers from around the world and bringing them into one central location, i.e. Index One. So today we're going to talk a little bit about what's happening in the market. So this is a chart of the S&P 500 going back to January of 2019. We wanted to put this in here because you can see the two arrows signaled market tops. The first arrow is during COVID. And it doesn't seem like it was that long ago, but it was about 5 years ago that everybody was wondering as the market was going down, were we going to get a V, a W, a U, an L, or some other shape? It turned out that we did, in fact, get a V, but that was a fairly significant drawdown. The same thing happened in the second arrow, in that the Fed announced, the US Federal Reserve announced that they were going to start raising interest rates to cool inflation down, which is always a bad sign for the stock market. That then led to negative returns of 15% or so across the broad stock market, and as well as negative performance for the bond market in 2022. And if we look more closely at today, this is the last year and 3 months, going back to January of 24. We've had a really nice run. The line going up and to the right is just generally the direction. And we can see that for the first time in over 2 years, we've had a drop below a whole bunch of moving averages. And so that's created some questions with investors and financial advisors around what's next. And so, the optimists think this is a blip. Some of the market prognosticators think that we're just going to be in the store for a lot of choppiness. And then other people out there in the bearish camp are like, no, this is the beginning of a recession or a bear market. The other thing that's interesting when we all look at across the whole suite of strategies is U.S. growth versus U.S. value in 2024. So this is just last calendar year. And you can see that U.S. growth, as measured by the Vanguard ETF, was up 31%, and the value was up in the low teens, whereas the S&P 500 was up in the 20s. And that's a huge divergence. I mean, it's a 20 percentage point difference just about between growth and value last year. Why is that important? Because when we look at year to date, things are changing. So the top line is Europe. We can now see that value is outperforming growth. So there's been this massive sector rotation between US and international and growth and value. And that all started, in late December 15th-ish. And we're really now seeing that play out. So investors that have needed to get the best returns have needed to be more active this year. This is another way of looking at that. So this is the 12-month benchmarks as of 2 days ago. And basically, you can see that the top performing index that we have on this page, which are ETFs, is the low vol, followed by the mscii EFA, followed by the S&P 500. So, and keep in mind, these are 12-month returns. If we look at the bottom of that list, we can see there's small cap down there and dividend and balanced, etc. And then off to the right are just a suite of BX and Index 1 strategies that have outperformed the S&P 500 over the last 12 months. And if we look at the categories, you get a little bit of international, a little bit of value, tactical. What we're seeing is these international and value strategies are now making up for lost ground by having really strong first quarters this year. If we look at it just year to date, we can see that the benchmarks are in much worse shape than they were in 2024. And the vast majority of benchmarks are down, the ones being upper value and international. If we look at the top performing strategies at BX and Index 1 year to date, they're almost entirely international and value that have outperformed the S&P 500. And you can see right here, the S&P 500 is down a couple percentage points for the year. So with all that said, I'm going to turn it over to Chris, who's going to talk specifically about some of the strategies and other ideas on new indexes and models.
Yeah, thanks, Craig. So we've onboarded a number of different new indexes or strategies since the last time that we featured them. I wanted to talk about a couple of them because I think it'll help you understand the way that we at BX think about what kind of things that we want to onboard and why we want to do it. So first, I'll mention we have the BX US Focus 10 Index, a relatively straightforward approach, and we onboarded this one specifically to address the desire of some financial advisors to include a sleeve that's very concentrated. So this one only has 10 holdings, but also has the ability to be tactical. So this strategy, as market volatility rises, has the ability to move to cash. What we really like about that is in the entire, the entire history of the strategy, the maximum drawdown on it is 20%. Which is dramatically smaller than a fully invested index, even though it's produced better returns. So what the strategy does, very simply, on a monthly rebalance basis, it'll allocate to the top 10 stocks from the S&P 100 that have the best momentum. And then if, in fact, volatility crosses certain thresholds, it'll move a bit to cash. So you can find the fact sheets for all of these strategies at index1.io or at bxindex.com. They're available on our website and Index One's website. Second of our newcomers, the BX US Dividend Growth Titans 20 Index. We have sister indices that have both 50 holdings and 10 holdings, but as it turns out, a lot of advisors were looking for something more in the 20 holdings space. We really like this strategy. In essence, it selects from stocks with a very, very long history of dividend growth, but we only choose from the top half of all yielders within that universe, which enables us to produce a portfolio that has about double the yield of the aristocrats index itself, and also has produced much better performance because in addition to just buying all the stocks that have grown their dividends for a certain period of time, it layers on a proprietary momentum definition, which enables the strategy to, by and large, bypass stepping into all the value traps, which is what so many of the dividend strategies do. And the long-term returns have been outstanding. Actually, even the year-to-date and one-year returns have been very, very strong on Dividend Growth Titans 20. And that is, as you might imagine, a 20-stock portfolio. Third, we've introduced the PMV Downside Defender Index. This is one that was already a part of the Index One family. And we got to know the index manager, and we liked the strategy so much we wanted to include it as part of the BX collection. So what this strategy does is it has a constant allocation to US equities, to US long bonds, and to gold. And then it's got an allocation to a very tactical ETF that'll rotate amongst all the different major asset classes in the world. So emerging markets equity, developed markets equity, short treasuries, long treasuries, commodities, the dollar currency play. And what we really like about this index is it blends beautifully into a mixed portfolio because it's got very, very low correlation to typical traditional assets. And the maximum drawdown on this strategy going all the way back for over 10 years is 14%, even though it's produced very, very strong returns. So that's the PMV Downside Defender Index. Finally, the last new index that I'll talk about is the BX AI Fund's Tactical Growth Strategy. This is very interesting. So this will hold about 7 ETFs. Typically, that number can change. Think of it as maybe between 5 and 10. And it's driven by an AI, a machine learning process called BELA, Bayesian Artificial Intelligence Learning Algorithm. And what it does, and this makes a lot of sense when you think it through, is it looks at a myriad of different economic and macro indicators and tries to match what's going on right now to what was going on in the past. And when it finds the closest fingerprint, it will allocate to the ETFs representing the asset classes that perform best in the environment that was most like today's. Once again, this strategy is very tactical. It can move to short-term bonds. It can move to cash. Stellar long-term returns and a maximum drawdown of 21% versus, its benchmark's maximum drawdown is about 30%. We really like to keep an eye on that maximum drawdown because it helps us to create portfolios that, we think are more durable, that clients are going to stick with for the long term. So those are the kinds of the new strategies that I wanted to talk about. Craig, would you have key takeaways for us?
Yes, thanks, Chris. Yeah, I think just to summarize, Index 1 and BX do not manage any of the strategies, but we search the world for strategies, which is very refreshing, and that we're open architecture. We consider ourselves leaders in the whole notion of active indexing, and think that active is important and indexing is important. What have the market's been doing? Well, we're kind of real-time analysts. So what we see today is that value and international are doing great, and growth, U.S. growth is not doing so great. So until that changes, we'll be, making sure we have a lot of diversification amongst a broad range of both stock and bond asset classes, and which leads to diversification. So you get the double benefit of lowering your risk by adding in those components. And then, as we kind of look through all these charts in our conversation today, we always kind of wonder, what is the client's objective? Are they trying to keep up with the benchmark, or are they more concerned about like dollars and actually getting a specific return? And then also, what is the client's time frame? Are they looking to get the best return possible over the next year, or do they have like a 20-year time horizon? So, G, I'll turn it back over to you for additional comments.
Awesome. Yeah, thank you so much, Chris and Craig. Very interesting things to come. And thank you so much for your valuable insights today. To our viewers, you can explore all the BX models mentioned in today's session on both BX's and Index One's website. In the meantime, be sure to subscribe to Index One's and BX email newsletters to stay updated on our next Portfolio Strategies Outlook video. Thank you for tuning in, and we look forward to seeing you next time. Thanks, everyone.